Welcome to Emerging Franchise Brands, the podcast that introduces you to the visionary founders of America's fastest growing franchise opportunities. We'll also hear from industry pros as they share insights on what it really takes to achieve the elusive milestone of 100 plus locations. I am your host, Frank Fiume, founder of I9 Sports, and my 20-year journey from inception to acquisition has given me a unique perspective on how to succeed in franchising. Join me as we welcome today's guest. Hello, everyone, and welcome to the Emerging Franchise Brands podcast. On today's show, I have a really special episode. I have the author, best-selling author of Big Money in Franchising, Alicia Miller. Alicia, how are you today?
I'm great. Glad to be here.
Alicia, I am so excited for this episode. We have so much to cover. I am a huge fan of this book. I have read it cover to cover. I have marked it up. I've made a ton of notes, and I have a lot of opinions too. I'm sure you imagine.
Yes.
First off, I want to share with the audience that in my view, you will never see franchising the same way again after reading this book. It is absolutely life-changing if you're a franchisor or if you're a franchisee, and I cannot recommend the book enough. I want to come right out of the gate and share that with the audience. The book has stirred a lot of emotion for me as a bootstrapping founder that has gone through the private equity process a few times. But I want to start, Alicia, by asking you, first off, what even inspired you to write Big Money in Franchising?
Because I saw there was a gap in people's understanding. No one's ever written about private equity's commanding performance in franchising ever like this. There's some legal papers and there's been some presentations at different IFA conferences and such like that. But no one ever talked about, how did it change the competition? How does it change the face of franchising? How does it change culture? What's the impact to franchisees? It was mostly about, getting a deal done, how to find a partner, very transactional kinds of things. And I thought, from what I'm hearing from founders, this is something that really needs to be better understood. So I figured, I've got a background in this and I can tackle it. And I did.
That's awesome. So what is your background?
So actually, I worked in high tech before I came into franchising. And like many other people, I, came in wanting to make a change in my life and became a multi-unit franchisee in the Sylvan Learning System. And I loved it and decided franchising was going to be it for me. This is the rest of my career I'm going to spend in franchising. When I took over these units, they were in distress. I kind of fixed them up and sold them. And then from there moved into franchise development and then more traditional management consulting, working with brands that were trying to break out. That quickly led me to private equity. And that's when I really got an eyeful of what was going on in the industry. And that's when I really started to deeply study it to understand it better and try to explain to these founders and owners, what is happening in the space and why. As I started to piece it together for myself, I realized that this gap existed in understanding. And that's when I started to really start writing about it.
Wow. Okay, Alicia. So before we get into the sections of the book, I'm curious to know, what were some of your biggest surprises during the research phase of this book? Because it is chock full of data.
Yeah, well, I'm sort of my own worst enemy there because you ask yourself a question and then you follow the thread and there's more threads behind it. And so the research just kept going and deeper. I think the two big surprises for me were around, these are professional investors that do this for a living and presumably are good enough at it to make a living out of it. But they make mistakes. And the mistakes seem to me, as somebody who's run a franchise business, as ones that should have been avoided in a lot of cases. Now, there have definitely been, situations where there's been bad luck or bad market timing or things like that. But there have also been mistakes of due diligence. There have been mistakes of execution, and especially mistakes missing the core of franchising, which is franchisees have to make money for this thing to work. They have to be satisfied with what they're getting back out of the money they've put in and the effort they've put in. If you don't have that at the core foundation of what you're doing, you don't have anything. But it's amazing to me how that disconnect has happened, especially early, and sometimes continues to happen with some private capital investors.
Okay. So, all right, with that said, I love your reference to the proverbial frog, that is immersed in a pot of water on the stovetop. And that almost like, it's almost like the franchise community didn't feel the heat rising. Nobody really noticed. So I'm curious for you to share quickly with us how even private equity came to dominate franchising.
Sure. Well, and let's define what dominate means too. To date, I can count 700 brands that have gotten private equity backing at either the brand level or the franchisor level or franchisee level or both. But if you believe Fran data, there's 4,000, 5,000 brands, depending on who you ask. So that means less than 20% of brands have actually gotten PE backing. But those are not coincidentally, the top 400 ranked by Franchise Times. They tend to be the top brands ranked by Entrepreneur. They also tend to be the top brands ranked by Franchise Business Review based on franchisee surveys, which are the most, in my view, the most important. The PE community has sort of cherry picked the biggest and the best brands already. And then there's this very long tail of brands that aren't yet attractive to private equity or aren't taking private equity money. They came in pretty fast in the 1990s after they had exhausted other opportunities. It sort of dawned on them almost at once. There were a few that sort of dabbled in the space. They had backgrounds in retail and malls, and they started taking on some restaurant brands and so on. But the ones that really got everybody's attention were the three big deals that Bain Capital did. They did $5 billion in transactions over about 6 years, Domino's, Dunkin', and Burger King. And they did so phenomenally well financially in those deals, and it was very well covered in the press that it sort of got everybody's attention. And the entire private equity community sort of was like, wow, franchising, what a great idea. This is a great market. And they started coming in en masse. And over time, each of the firms sort of figured out their level, where they were best able to play effectively. Some, I tried to organize them on a ladder because it's sort of the easiest way to think about it. Mm-hmm. Some are interested in, large deals. Some are emerging brand specialists. Some like turnarounds. A few of them do. And they sort of have all figured out their strategy to win in the franchise sector. And now we've got more than 400 firms have come into franchising and have settled themselves along this ladder, and more continue to come in. That's what's amazing to me. There's so much money sloshing around looking for a home that we will continue to say new firms coming in.
And we're really, just as you said, we're scratching the surface. 700 plus brands that partner with private capital. There was an interesting quote you put in your book that I wanted to share. And that was, it's about the fact that private equity is all around us, as you stated, but oddly enough, they're kind of at this distance from the franchise community. And the quote that I love is from Matthew Haller, the president and CEO of the IFA. He said this: they need to be in the room, not in the lobby at franchise events, cherry picking founders they want to talk about possible partnerships.
Yeah.
What are your thoughts about that?
Yeah. Well, look, I mean, the IFA, there's a lot of pushback on the franchise model. We have to continue to educate. Franchising's not well understood by people who aren't in it. And it's especially dangerous when regulators and legislators don't understand the franchise model. They can make bad laws and bad decisions. And so it's all of our job to continue to educate and share stories. But that takes money and time and effort to get in front of all of those people. More of us need to be telling those stories. And so it's not just enough for the private equity firms to make sure that their portfolio companies are active members of the IFA. But, ideally, we'd like to see more private equity firms themselves participating in some of these things. I think only a dozen private equity firms are actually card-carrying members of the IFA, strangely enough. Mm-hmm. So it would be nice to see more of that activity and not just, as you say, kind of milling around in the lobby outside of the conference hall. And you can always tell them by how they look. They have a distinctive look.
Yeah. I think I had that same look when I was in medical sales back in the 90s, and I'd show up in the operating room with my suit on and my bag, and the doctor would come out of the operating room going, "Oh gosh, here's this kid. He's going to sell." Sorry. Yeah, that was me. So I get that. Okay. Let's move on to the private equity playbook and franchising. Truthfully, this is where your book started to stir a little emotion for me, because I found that the private equity playbook, truthfully, it's not really much different than a founder really trying to create a world-class brand. And I thought your book did a great job of establishing the playbook itself. But the disconnect for me was, wait a minute, this is how me and my team built I9 Sports, focusing on unit level profitability, expanding on franchise development function, focusing on processes and support, making improvements to marketing, tying the operational improvements to customer satisfaction, and then renegotiating supplier agreements to lower franchisee costs. Like, that is how we built our brand. But I get it. When you're a founder that maybe doesn't have the right team, this is what private equity knows to do this. And they do this with a very, very simple, with one simple reason, right? What's their one simple reason for being in business? Higher returns, as you pointed out.
As a sector, whether you call it a sector or an industry, franchising is much better at launching new franchise businesses than we are at getting them to meaningful scale. The ones who get it to meaningful scale follow this playbook. It doesn't matter who's running the playbook. It could be you, it could be a private equity firm, it could be a family office helping out. But I think the numbers don't lie. I mean, there are literally thousands of small brands that haven't been able to break out. For whatever reason, they're not following this playbook. Either they don't know it exists, or they can only implement part of it, or they're not well enough capitalized to run it effectively, or they can't attract the talent needed to pull it off. And private equity can come in those scenarios and light a fire under an otherwise, a brand with good bones and a good management team, and they can add value quickly by implementing whatever's not done in this playbook and really pushing the envelope on growth in particular. That's where they can unlock the value pretty fast.
Right. I agree with you in that, look, they take the emotion out of it. They're not connected. They have, they have one purpose, as you put, and that was the higher returns. It's for the next fund, right? Their purpose is to raise money for the next fund so that their investors are successful so they can start another fund. And it's just rinse and repeat for them. The interesting part of I'm going to probably say this again and again, interesting part of your book, but I think one of the big trends that we're of course seeing now more than ever is about private equity's very simple playbook around platforming. And I thought maybe it'd be great if you share with the audience sort of that, where they developed the conviction around a theme or sector, and kind of walk us through from there.
Sure. This is where private equity really got excited about franchising. If they weren't before, when all the Bain stuff was going on, they really got it when they figured out, because platforming is a tried and true private equity method. Basically, you buy companies and the sum is greater than, adding up the parts, right? So you can get cost synergies, you can do cross-selling and cross-marketing. You've got other staffing efficiencies. You can get in, you can expand much faster if you're adding brands to a platform. And that happens to work really well in franchising because so much of the back office function is the same across, you need arguably the same kind of team in many different types of franchises, no matter whether it's a restaurant or a wellness concept or whatever. But if they're thematically similar, so let's say restaurant brands, you can also get some pretty big supply chain breaks if all of that spending is on the same platform. And you can also do better job with franchise recruiting and cross-selling and cross-marketing across all these different platforms or all these different brands in the platform. So once private equity sort of figured out that this strategy was going to work really well in franchising, that's when we really saw a huge uptick. Right after the financial crisis, it started to accelerate. And, there were big investments in the restaurant sector, and then home services really took off. Now there's 20 different home services platforms. It's crazy.
Yep.
But, it's across wellness and beauty and, senior care and child services, business services, basically the same playbook follows. It's just a question of finding brands that have reasonable synergies, both for customers and the customer life cycle, and also for franchisees who potentially might want to own more than one brand.
Mm-hmm. And as you pointed out, no matter what happens, private equity is set up to win. I think there's a lot
Don't hate the player.
Don't hate the player. I think there's a lot of people, a lot of folks in our audience that really don't even know how private equity gets paid. So let's talk about that.
Sure. So I did include a chapter in the book on how they got paid because I recognize a lot of people don't understand that. So their basic model is what they call 2 and 20. They get a percentage of the carried interest, the profit that they get in the business, they also charge management fees, typically, but not always. Sometimes, especially in smaller franchise brands, they don't do that. But they can also take money out by taking debt on the business and taking out a dividend. They can provide a loan to the company and get paid that way. There's lots of ways that they can take money out of the business, even a business that isn't doing very well. And that's different from a franchisee and potentially that same system. In the earliest days of private equity's work in franchising, many of them, I think, were a little overconfident in their ability to turn around a franchise system. And we saw them, putting debt on businesses that were already sort of in trouble, and they weren't able to turn them around, but they still got themselves paid. It's part of the model. And,
Right.
It's something for people to be aware of.
Yeah. You mentioned the 2 and 20, but I want to go back to that. I don't think that everybody knows that, they typically charge 2%. They're getting paid 2% of assets under management from all the money that they've raised from outside of investors. So they're right off the bat. From the money they raised, they're already getting 2%. And then usually 20% of the profits after hitting some sort of hurdle that they're taking in. It's typically like 6 to 8% is
6 to
sort of the
8%.
average. Yeah. Okay. And that's on top
Yeah.
of course, the generous salaries of an associate.
Yeah.
So they're not
The associate salaries, when I looked that up, I was pretty floored at what even junior people get at a private equity firm. But so the behavior that comes from that is very predictable. So the first thing is their next raise is what they're focused on. So they want to have good outcomes, good exits, and therefore be able to raise the next fund because they're getting partially paid out of the size of the fund, basically, right? So their entire reason for being is deploying the capital, so that at some point they're forced to make, they've got to move forward and make these acquisitions, but they also at some point have to return capital to investors. So that's behavior number one. Number two is there's a lot of incentive for people who learn the craft, do it well, to go then start their own fund, right? Because that's where the real money kicks in, is when you are the general partner, not the underling. So that's why you see so many of these firms that are active in franchising have a long history in franchising at other firms, right? So these guys do move around, or they start their own firms, because that's where the biggest benefits are financially for them.
Well, let's circle back now to the emerging franchise founders and how this really relates to them. Let's talk about some of the common emerging brand challenges that don't interest private equity. I thought you did a great job of identifying this.
Yeah, because, I think, unfortunately, somehow emerging brands have gotten the message that it's only a matter of time until they're acquired. That's not true.
No, it's
Right.
not.
There's thousands of brands who will say that's definitely not true because we've tried and nobody wants to talk to us. They're not interested. Look, their mandate is they want to grow. Most of them are growth investors. So especially for emerging brands. So they want to grow the business in a reasonable amount of time. That's usually 6-7 years. And then sell it upstream to the next private equity firm, presumably. So they don't have a lot of time. They don't have time to fix turnarounds. They don't have time to do a big lift from nothing. They want proof of concept. They want a backable management team because they're not operators themselves. They want to see momentum in the brand. They want franchisees making money, good franchisee satisfaction surveys and validation, and a sold not open funnel that's attractive and real. If they don't think it's real, it'll be a turnoff, right? So if you have 10 units open and you've sold 800, there's going to be high skepticism about that. They're going to say, well, hey, if you believe that's true, then get them open. Come back when you've got 150 open, and we'd be excited to talk to you. So these are the problems that private equity doesn't want a mess. They want more of a sure bet. So you've got to make sure that you're not showing up to a conversation with a potential investor a little broken, because they're just not interested in that. That's not what they want. That's why understanding what they want and building right in the first place not only sets you up for a potentially more lucrative equity sale when you're ready to do it, but does better for your franchisees because you're building right in the first place, and all the tide will lift all the boats.
Right. And it's so obvious when a franchisor is building their company to flip it, when they have so many franchises sold, not open, and then you ask them about that corporate team and they've got like, 2 people in the back office. Yeah, it's like
Right.
what you're trying to do is trying to get this thing flipped as quickly to private equity as possible, but it's so obvious. And that's not how you grow a business. Not to mention how dangerous that is. It's sort of like flipping homes and you get caught in a bad economy.
Yeah, it's not helpful to franchising in general either, because
Yeah.
if you end up with, the wreckage of unhappy
Oh,
franchisees, that just makes everybody look bad. So it's not helping our cause here at all. And the irony is that they really aren't going to attract private equity.
right.
There are some emerging brand investors who might be willing to take on a lift like that, but there are not a lot of them. There's certainly not enough of them to make that your core strategy. That's not a good go-to-market approach.
Yeah. One of the things that you shared in the book was about PE's dominance. I totally agree with this. PE's dominance and influence, it has changed really how the new franchise or startup is, in that even the deck is stacked against the bootstrap founder. But I do want to point out it can be done. And if you're doing the right things, do not fear the competition that you're going to encounter, that you can still win.
Yeah.
But whether you are involved with private equity or not, you are involved with private equity because your competition may be. But it's not a reason to go saying, I need a PE partner, right?
Correct. Yeah. It's just the reality of what, especially, in some of the more crowded sectors. If you're launching a home services brand today,
Mm-hmm.
you're launching into a crowded sector with at least 20 platforms already established, focused on home services. Try to build a brand momentum in a market when, like, let's say you're a mosquito services brand. Okay, well, there's already 20 or 30 of those to begin with. Plus, every one of the platforms has one of those. So how are you going to compete from a local marketing perspective? How are you going to get customers to compete against all the stuff going on in your market? You've just got to think it through. The game has changed. It is what it is. It means you need to be better capitalized.
Mm-hmm.
It means you need to be more thoughtful about your marketing approach, how your unit level operations and how franchisees can achieve profitability. And for many brands, it means, this model that we've had recently where people have one corporate unit or no corporate units and then start selling franchises. I just don't know that that's very sustainable. You've got to have at least a few corporate units because you need the cash flow. It's going to take you longer to get this thing up and going than you think it's going to. If you've got the corporate units, then you've got some extra cash flow to fund the support that you need and to really make sure the market is well done, or the operating model is well done before you go to market.
I agree with you completely on that. I always tell people, do as I say, not as I did, because I lived a very stressful life of trying to keep the lights on by selling franchises, because I had one company owned location and I inevitably sold it to fund my business to franchise. And and the first franchise I sold was right in my backyard, as it turned out. So, it was all the things. Don't do what I did. But I agree with you. Considering opening a couple more corporate units to determine the viability and just having that cash flow so you don't feel that unnecessary pressure. Another great point you made is that, PE's involvement in franchising, what it does is it sets up weaker concepts to fail faster. And I do love that. And I do think there needs to be a cleansing. Just as we went through this during the Great Recession. I remember when we were at the IFA events and actually the Franchise Development and Leadership Conference in October of 2008, when all hell broke loose economically. And I remember hearing, there was sort of a, the sky is falling. But the other thing we were also talking about were there were quite a bit of number of concepts that shouldn't have existed. They were a mediocre business that survived because the economy was good prior, and now they weren't going to last. And this is like a different version of that, Alicia. This influence is now going to make weak concepts fail quicker, which that is a upside to this, to the consumer and to potential franchisees that are looking at franchises.
Yeah, they're just those little concepts just won't be as likely to break. Doesn't mean it can't happen, but they're not going to be as likely to break out because it's hard to get traction with potential franchisees in particular. So to me, that's a good outcome. We don't want any franchisees to, franchisee signing on to an emerging brand is already kind of a maverick and a risk taker to begin with. But, to me, waiting until that brand has more units open, especially if they're corporate units, is just a better way to go.
Yeah. So Alicia, let's talk about the profit ladder in franchising, specifically these rungs on the ladder that you've identified in franchising that I came to, experience firsthand as well. Why don't you share with the audience what that's all about?
Sure. Well, it just acknowledges that brands go through different cycles, and PE firms themselves tend to specialize. The trend is not toward generalists. Now, the trend in private equity is to really specialize and to deeply understand a sector to be more effective in that sector. And in franchising, that bifurcates down into emerging different verticals in some cases. So like food, not food is a common sort of inflection point that people have to decide. But the firms organize themselves along this ladder, and some will only, continue to play in the emerging space, and they might ride it up for a little while, but really that's their sweet spot and where they're most effective. That's where they're going to play. There's others like Aurora Capital that your business ultimately sold to, where they prefer much larger scale brands, and they'll do a long hold and continue to nurture that brand and grow it over time. So you can kind of clearly see where private equity firms are going to land on this thing. And the other thing that people don't maybe understand is once it's gone to its first private equity deal, it's going to keep retrading over time on a fairly predictable cadence. That's just what happens. Mm-hmm. So for franchisees, it's something to pay attention to, right? If you're already private equity backed, you're likely to stay that way for quite a long time, but the ownership may change.
Mm-hmm. And this is why I say, said right from the beginning of our show, why this book is so important for not just franchisors to read, but for franchisees, because if you are a prospective franchisee looking at a brand, you want to know where this franchisor is on the ladder. Are they not even in private equity? What's the founder or what's ownership's view on getting involved in private equity? If they're on that first rung on the ladder, let's talk about some of the characteristics. I went through the first rung on the ladder where I wanted to take some chips off the table. I was the founder that still loved my company. I wanted to be involved, and I networked, I think, properly with PEs that were looking for the first rung on the ladder, right? They were folks that wanted me and my team to still be heavily involved. And I found great partners that basically said, you guys know exactly what you're doing. Here's the money. We know we're going to get a great return on it. Just keep doing what you're doing. And the managing partner from the private equity that I worked with years ago, he came out so far to say that, geez, he goes, Frank, if I had 20 of you guys, I would just be sipping Mai Tais on the beach all day. There is nothing for me to do with your company. You guys know exactly what you need to do. Now, that was a far different experience than the next rung on the calendar when LNC Capital decided to sell to Rourke, and they have a different view on things, right? So why don't you share then what that next rung usually looks like when private equity sells to private equity?
Okay, so that sponsor to sponsor transfer is where there can be a lot of change. In that first deal, the founder, has say over who that partner is and what that partnership is structured like. And are you aligned on your goals together? And, do you feel like you could work with this firm? Hopefully, founders do a good job of vetting the partner, that first partner. It doesn't always happen, unfortunately, but hopefully they do. But in the second transaction, you've already sold majority control of your business. Now, someone else is making the decision about who buys it and when and what they're going to do with it going forward. That's when the culture really can change quite a lot. And it can be jarring, especially for franchisees who came in under the old model and really maybe were even sort of emotionally attached to that founding team and that founder. 10 years later, it now belongs to a larger private equity firm, and it feels really different as a business compared to what they signed up for. And unfortunately, that means in some cases, franchisees might need to move on and do something different because the business is going in a different direction now. So it's something to be aware of. Your 10-year license agreement, 10 years is a long time, especially in an environment where firms are retrading their holdings every 4, 5, 6, 7 years, right? That's shorter. So you may be going through 2 or more private equity owners during your time as a franchisee. If well managed, the business can continue to grow like gangbusters. In the book, I used the example of Tropical Smoothie Cafe, which has been through a series of private equity owners and has continued to flourish and grow in an amazing way. And now they're talking about potentially doing an IPO because it's been so successful. But, you've got to check the track record and talk to franchisees who have been in the system. And, what is it like under this particular private equity sponsor? Is it an effective relationship? Do they listen to franchisees? Do they have a good management team in there? I mean, that's their number one job, is putting a great management team in place if they're not going to back the existing management team. So is that management team effective? You got to ask a lot of questions.
Yeah. Okay. I was going to cover this towards the end because it's the end of your book, but I think this is really appropriate to talk about culture. You raised the question, does culture matter? Because it does change, right? When you start out as a founder, it's all about the culture. It's all about the passion. It is all about the relationships with the franchisees. And you're a close-knit group of people. You know your franchisees, you know their families, you know everything about them. And then, however, you point out that as private equity gets involved, it becomes less about culture and more about meetings and more about metrics and reporting, which there's nothing wrong with that. I think it's a happy medium. Somewhere you have to walk the fine line. But you raised a very, very interesting point about, does culture matter? Because at the end of the day, it's now a machine. What are your thoughts on that?
Well, I hope that no matter who owns the brand or whether it's publicly traded, to me, somewhere in the culture has to be franchisee profitability and satisfaction is core to everything this management team is focused on. If that's not part of your culture, then you're not going to be an effective franchise business. So hopefully that part of the culture does not change. The more emotional, touchy-feely part that we used to find much more in founder-led businesses, I've argued in the book that we've got so many now that are being built to flip that I would argue that some of that culture has gone away. And I think that's unfortunate. But you can see it in some of the even big transactions that are happening. Subway is about to trade potentially. And now in this last week, Jersey Mike's is rumored again to be potentially considering a private equity transaction. Those are very different scenarios, right? Because Subway is now being sold by essentially the estates of the founder and his initial backer, whereas Jersey Mike's, the owner of Jersey Mike's is still very much involved in the business, and culture really does matter to him. Mm-hmm. And so he's got to make this decision now. Do I want to let in a partner? And what does that first partner look like? Because this is his last opportunity to choose somebody who, is going to value that culture and continue it forward, because whatever the next transaction is, that will be less of a concern than the financial piece of the equation.
When I read that part of the book, Alicia, immediately what came to mind, and I'm not going to name the company, but I think folks will be able to figure it out. There was a quick serve burrito company franchise that when they first started, I remember they were, not only were they the hot place to go, but everything was fresh, everything was clean. You were welcomed when you walked in. Everything was so good. When it built up and was eventually sold to private equity, you walk into the place, it's dirty. You don't get welcomed anymore. I stopped going years ago because anytime we've gone to one of these locations, or we stopped going, it just was not the same. And I don't want to blame private equity for this, but there was definitely a disconnect in that it felt different walking into this location, many of these locations, many, many years ago. And it's a lot different in the past, 5+ years. You know what I'm talking about?
But can we exactly blame private equity for that? Or can we blame the change in franchise recruiting and how we think about franchise operations, right? So if the culture starts to change to be more clinical, more coldly KPI driven, and you miss that consumer connection, and you're not recruiting owners into the system that have a passion for making sure that their unit level operations are awesome, then you can make that mistake with any sort of ownership structure. I think the risk is higher with private equity because they're sort of they're at an arm's length, and they're running the business through a management team. And if that management team is not keeping on top of those issues and working with franchisees to make sure that those units are nurtured as being, strong brand representatives in their community, then that's when you go off the rails. But I think can be more likely to happen under a professional management team where that personal connection starts to go away. That's when it gets harder.
Yeah, I point this out because I am not anti-private equity at all. And I don't want to blame them. I agree with you. They're not to blame. But I do think that there could have been a lack of focus on some of doing some of the right things. When you taste the food and you see that there's a clear difference, that the quality went down, it makes me think, okay, we focused even so much more on profitability that we've kind of crossed over into, it was so much about the profit, it was not so much about the quality anymore. And it just seemed more machine-like. And I'm not blaming private equity, but certainly there's an eye off the ball there that needs to be addressed, because it was a really good brand, a strong brand that just seems, as you said, very clinical.
Yeah, you've got to maintain what makes your brand successful in the first place, and that connection with customers. I think that's why, if I remember correctly, that's why Burger King has got this new rule where you can't have more than 50 units, because they want more of that owner operator mentality to come back into the business. And, it's publicly traded under RBI, so it's not a private equity issue, but they want to bust it up a little bit. So the result of that is they will discourage more PE activity at the unit level, because PE wants to build scale. And if you can only own 50 units, okay, well, there's a limit to that. So we'll see whether that experiment improves unit level operations as they intend it to, by busting it up and putting it under smaller owner operators.
That makes sense. I don't want to spend too much time on beating up PE, but you did a great job in part 4 talking about smart money bloopers in franchising. So just for the audience, we have a lot of emerging founders that are considering private equity as part of their expansion. Share with the audience, what do you think are some of the most common mistakes that are made? And maybe it's great for the founder to kind of hear this as they, are vetting potential partners.
Sure. I think as a founder, go through that chapter and really soak on what it's saying, because you need to check references and check track record. Look, anybody can make a mistake and you can learn from those mistakes. We've seen prolific franchise investors, one brand hasn't done quite as well, but they've gone on to be very successful in other brands. But you got to learn from your mistakes and do things differently. If you're an investor who continues to overload large companies with too much debt, and you take out too much in distributions and you're not investing back into the business, that's not going to go to a good place, right? Right. It's just what's happening. As a franchisee, that's probably not someone you're going to want to get involved with. And certainly as a franchisor, that's probably not someone you're going to want to get involved with. But the reality is, by the time you get to those bigger debt situations, the business is already traded several times anyway, right? So the founder is probably not making that particular decision. Debt is really not a factor for emerging brands. They are bought for cash because they're too small. So the debt issue only becomes really a factor when the brand gets much larger. The question emerging founders should be looking at is, how have brands done under this PE sponsor? Has it continued to grow? Is franchisee sentiment still good? Mm-hmm. Are franchisees coming back and buying more units? That's always pretty high on my list of things to look for. What do they like to work for? They're going to be tougher than, the hardest transition for many founders is having a boss. You got into the business in the first place because you wanted to be an entrepreneur and run your own show. And now you've got essentially a boss. You've got a board of directors you report to. You can't just do things you wanted to do the way you wanted to do it before. You can't just go hire somebody. You got to clear it with the board. So just that change in itself, you've got to make sure that it's worth it to you, that they're bringing something to the table that you can't do yourself, that's worth the trade-off. That now you do have a boss and you do have to listen to them, and not every decision is going to go your way, right? But only you can determine whether now is the right time and whether this is really the right partner. But before you start talking to anybody, you really should be thinking about your objectives, right? So, too many people pick up the phone and start talking to private equity, but they've never even really thought about what they're trying to accomplish here. They're just excited to get the the first phone call. That's not how you should start the conversation.
Yeah.
You really got to soak on your own objectives.
So, and you pointed this out, the founders really need to start with their why. Like, why are you even thinking about bringing on a PE partner to begin with? What are you looking to accomplish? What is your vision for the business? You know, is this something, is this your legacy? Is this something you want to do for life? Or is this something that you're building that you see yourself doing maybe X number of years because you are, you know, getting to 50 years old and you're looking at your net worth saying, oh my gosh, it's so tied up in my company. That's why I did my transaction. My wife and I were about 48 years old. My son, our youngest, was finishing up high school. And I started thinking like, oh my gosh, like all of our net worth was tied up in our company. We would just always just keep reinvesting the profits of our company. So my 401k, my IRA was pretty embarrassing. And it got to the point where it was about taking some chips off the table because the risk was getting way out of whack, where I thought, gosh, we're like one disaster away from ruining everything we did. And that was sort of my why. Wasn't because I didn't love my company anymore. I loved it dearly, but de-risking was extremely important. And I think that's, you know, as you point out, you need to really know what your why is. So Alicia, I thought another great point, I know I've been saying this again and again throughout our interview, but PE is not a bank. They hold equity, they have a seat at the table. And it's really important that, you know, founders need to align themselves properly because they need to set clear expectations, right? And I don't know if I had clear expectations when I started. I didn't know what I was getting myself into when I first engaged with private equity. Unfortunately, it all worked out well, but I could have easily seen how it could have went not. What are your thoughts?
Yeah, I would say not only define your why, but be very clear about what help you're looking for, because that will help you narrow down the list of potential partners who may or may not be good at exactly what you need. You might be coming into this thinking, you know, where I really need help is tightening up the operating manual. You know, the franchisees are not functioning the way they should, and I really need help and advice to tighten this model up before I take it outside of my region. Okay, perfectly legit. You might say, well, gosh, we've got the model nailed, but where I'm really struggling is franchise development and marketing. Great. You know, you might say, okay, well, we want help to grow, but we want to do it in a particular part of the world. We want somebody who's got experience taking a brand international. And then there's other more subtle things to keep in mind. So let's say that you're running a business that has heavy on healthcare, for example. It might not occur to you that other people aren't as steeped in that sector as you are. And you've got to think about how important is it to me and to the brand's success that my partner understands this particular sector I'm in or not. You know, you could make an argument either way, but you don't want to get there by accident. You want to really vet that partner and understand what they do and don't understand about your market, because that will prevent disagreements and misunderstandings later. You know, once they've got majority control of the business, if having really deep information and knowledge about the healthcare sector is important to making good strategic decisions, and they've never been in that sector, you know, predictably, you could run into some trouble there.
Yeah.
So just think about that really carefully. And that can change over the course of the life of the business. One of the guys I interviewed was Senior Helpers, Peter Ross, and he talked about how, you know, they went through several PE transactions, but in the most recent one, what was more important then was having a healthcare partner with deep understanding of acute, post-acute care. Okay, well, that's the next phase in the company's growth, but being very clear about that narrowed the field and made it much easier to find a partner that made sense.
Yeah, and it's as you point out, it is the best partner is not the one necessarily that writes the largest number on that letter of intent, right?
Yes. Well, and that letter of intent is just a number.
Which changes as due diligence happens.
It can change. Yeah. Don't be sucked in there. That can change. Lots of deals go sideways. And, you know, for a founder, another thing to keep in mind is if you get to the point where you're entertaining multiple bidders and you've got an LOI and you accept the first one, try to keep things warm with the other bidders, because things can go sideways. People can change their mind for lots of reasons. And, you know, just because you've got a signed LOI does not mean you've got a deal. The deal's not done.
For sure. The biggest surprise for me entering the realm of private equity was the amount of data that was going to be required. that needed to be, uploaded into the data room. Fortunately for us, we have a central database where we have all of our customer data. Everything came back to us. So for us, it wasn't that challenging to be able to gather all the data for all of our franchisees since we had access to it. However, even that said, it was enormous. And in some regards, we would go through, a phase after phase of the due diligence and saying, when is this going to be over? Like we've literally given them.
Parse this data.
Yeah, I remember.
What are you looking for?
Yeah, I remember the president of our company saying, I have given them everything but my blood. That's when we knew, by the way, we were at the end. When you say I've given them everything but my blood, you are literally at the end of the process. There was nothing left to give. And this was actually a smooth transaction, I may add. This was not a difficult one.
Well, I think more brands now are approaching the sale process smarter, where they're bringing their data room together earlier. I provide a list in the book to get you started, to help you start to build out. Here are the common things they ask for. So at a minimum, you should have those. But yeah, they'll look at data in all sorts of ways that you haven't thought of the business before, which in some ways is their strength. They can uncover opportunities you may not have seen, but it also can be a little bit of an irritant. This is another thing that you've got to kind of think through. This is not just their MO, their modus operandi in the purchase process. This is how they are in life, right?
Yes.
And how they're going to run this business. So when you're having board meetings with them, this level of detail is what they want to see going forward. And how well do you get along with that perspective? It can be very helpful to uncover new opportunities for growth or cost efficiencies or thinking about the business differently. But if you've already gone and made a decision about, for example, what type of vanilla supplier you're using in your soft serve, and now they're second guessing which supplier you're using and whether it tastes right, and you're saying, no, this is what we've always used in my business and yada, yada, yada. If you don't want to be having those kind of granular conversations, then perhaps working with a private equity firm is not a good fit for you at this stage, because that is absolutely the level of detail that they can get to. And the other thing that's interesting is the evolution of the management team. Once you've worked for a private equity sponsor, you become a different operating executive. You may never get to be quite as quant heavy as a traditional private equity practitioner, but your perspective has been changed forever. You can't unsee it. That can make you a really powerful operating executive going forward in your next gig. If you're, for example, on the management team, once you've proven that you can continue to grow a business, you can speak that language, and you can do a good job under a private equity sponsor, given how many private equity sponsors there are now owning brands and franchising, that opens up some new career possibilities, as well potentially as some independent sponsor possibilities.
Yeah, no, it is definitely a different game. And you point out that private equity is going to see things that you can't see. In some cases, maybe as the founder, we're just too close to the business. And in cases where somebody treats it like it's their baby and they're not willing to admit that the baby is ugly, they really need some outside perspective, because somebody needs to tell you the baby is ugly. It needs to be improved and needs to be fixed. You need to at least have a sense of reality that, look, this is a business that needs outside perspective and folks that have done this before with other companies. But at the same time, when you're doing the dance with people, a private equity firm is going to put on their best face. So I think founders that are watching this right now, Alicia, are going to relate to this. You know how a prospective franchisee comes into discovery day and they act like they're perfect and you love them and they love you? Well, they were on an interview and they were showing, that was them at their best. It doesn't get any better than on the interview. Well, private equity is no different, that they are going to show up saying they're going to support you and I'm going to do all these things and you get to do X, Y, and Z. And you have to make sure that you really like them a lot. They're folks that you want to hang out with, because you are getting married to these people and they're going to be on your board. In fact, I think you pointed out, Alicia, in many cases, I experienced this on the next rung in our profit ladder, that the private equity wanted to control the board and that they are the final decision maker. They may be the boss that you never had.
That's right. Yeah, that's absolutely true.
You quoted my dear friend Lane Fisher in this book. Lane said, "You may find yourself feeling like you're working for the man again." That's true.
That's such a Lane thing to say,
That is,
isn't it?
it's very lane.
Yeah.
It's very Philly. It's very
Yeah,
lane, but it's
it's
true.
brilliant though. It's very true. I mean, all of a sudden you've got a boss. Think about it. You brought up the franchisee perspective. We have seen people rush sometimes a franchisee buying decision.
Mm-hmm.
And we all know that if you rush that buying decision through a very, very fast franchise development process, the risk is higher of buyer's remorse because
Yes.
they haven't fully soaked on whether this is the right franchise opportunity for them. You haven't really gotten to know them deeply. No, you just charge forward, sign the agreement, and now bad things start to happen. Well, the same thing can happen in a private equity transaction. If you move too quickly and don't really think about whether this is the right partner for you, bad things can happen. But of course, time also kills deals. You've got to be aware of that. Same thing happens with private equity. So you don't want to dawdle forever. They may just change their mind and move on, and then you've lost a potential buyer.
Mm-hmm.
The best thing to do is start really thinking through your why, what you want to accomplish, and who the most likely type of firm is going to be, and start doing some networking ahead of time, long before you open up a process. Then you can start to eliminate, yeah, I like these guys, I don't like these guys. These folks are interesting, I'd like to meet with them. You can get to know them a little bit outside of the pressure of any sort of transaction that's happening, right? And I work with these guys. They're often very generous with their time and with their advice, and you can get some feedback on your model that you'd like to know now, not in the middle of a process.
I have a friend who did something that I had not seen anybody else do, and that is they interviewed a whole bunch of private equity firms. They found out exactly what they were going to do, and you know what? He said no to every one of them. He walked away from all the deals, and him and his brother hired a CEO, and they're building their company, taking the PE playbook, and they're doing it successfully. Now, I know not everybody can do that, but I think we need to give hope to the folks that are listening to this that are founders. And why can't my leadership team just borrow this PE operating playbook and build the business, right? And they can, right? So let's share some of the things they need to do, Alicia. I know you started out with saying, think about, have we exploited every opportunity to build a high quality business, right? What are some of the other things they should be doing?
Start with your franchisees and your operating model. I mean, that's really at the root of it. If you do that, and if you haven't fully tended to the quality of the relationship with franchisees, start there. I mean, those are no-brainers, no regret move that you can make right now that arguably shouldn't require extra capital to go and work on. Start there. There are lots of other things included in the playbook that you can, in theory, go and execute yourself. And some, for example, you might say, well, updating the tech stack is a stretch farther than we're able to go. Okay, well, so that one is not now, but there's other ones that you can work on now that aren't as much of a stretch. And I think too many people approach this, well, maybe we should start talking to private equity without fully exhausting all the things they can already do themselves to grow the business, to expand margins, to expand EBITDA. And therefore they come to market and they're sort of disappointed with what the market tells them. Well, there's no reason why you can't go and execute some of these things on your own if that's within your capacity. Now, if you go to market though, or you start networking with potential buyers and they give you feedback, and then you come back to the market 18 months later and nothing's really changed, that's a different problem. So I think that's where many teams would benefit actually from starting to work with an outside partner, because they've shown there's something in how they're operating that's driving inertia, and they're not able to get past themselves, right? So that would be a circumstance when coming in with an outside partner might make sense. Or if they're in a sector where the competition is just really tight and they're struggling to get really good franchisees into the system, even though their model is good, that's when, thinking about maybe taking on a platform partner or working with, getting some help on the franchise development and marketing side would be a beneficial move.
Yeah. So if you're a founder that is considering taking everything you've learned and feedback and doing it yourself, I think you point out really well, do not spin your wheels. This is not the time to say, oh, I'm going to try and dabble in these things. We want to do things that are activities that are going to downright affect the EBITDA and affect, top line revenue, affect the unit level economics of the franchisee, maybe even taking the top 3 initiatives of the things that need to be done or closing the gap on some of the things that exist with your team.
You know what the missed opportunity is that I see very often?
What's that?
is many founding teams do not have a great finance partner. You need a good VP of finance or a good CFO. They can be a really critical thought partner to help you crunch through some of this stuff long before you ever bring on a private capital partner. And that's often a missed opportunity. They've got, they might get started, they might do the books themselves, then they might bring in a bookkeeper, then they bring in, their CPA part-time. But what you really need is a thought partner with a strong finance background who understands franchising. That person can, even on a fractional basis, deliver way more value than they're costing you, to get that outside perspective on how you can tweak the model and improve things for the business and for franchisees.
I can call it fate, I can call it luck, but I will tell you that that is exactly who I had. The heart of my company started with my VP of finance, who, believe it or not, started as my bookkeeper 23 years ago. And this lady is absolutely phenomenal. And I give her so much credit on why our company became who we did. A lot of it was her. Her influence in our company was tremendous. And
Yep.
I was very, very fortunate. And I know not everybody is, but having somebody it's one thing to manage the money, manage the finance, another thing to be able to critically think how to make things work and to grow the business. And she was able to do that. So yeah, that was Kim. So that's a big reason why
Shout
we
out
succeeded.
to Kim.
Absolutely. What to expect if private equity buys you? Let's talk about that a little bit as a franchisor.
So if you're the franchisor, everything changes, right? You now go from being the founder and the team that's running the business. Now you're the operator and you've got a boss. So, and all that comes with that. And that's why picking a partner thoughtfully in the first place is a good idea, right? So you get along with some people, you don't get along with other people. Doesn't make it right or wrong. It just is. And you got to hopefully pick a team that for that first transaction, that's going to be a good fit for the culture of the business that you want to hopefully try to take forward together. Everything's going to get faster. The pace is certainly faster. The focus on the numbers, and it's not an environment where you can sort of, you can make things up and sort of just wing it. They want everything known precisely. And the cream will sort of rise to the top. And, it can be very good actually for people in the business who maybe wouldn't have gotten noticed before because there's a hierarchy above them.
Mm-hmm.
Now that director turns out to be an absolute superstar, private equity will look at that and go, wow, that person's a superstar. We need to elevate her. She's got some real skills. Whereas before she might've gotten blocked because of the politics. Now it's the meritocracy all the way. They want people who can deliver on the mandate. If you can't keep up with that, that's going to be, you're not going to be happy with the outcome. So
yeah,
from the franchisor perspective, things just move much, much faster.
Yep. Everything's about reporting. Alicia, to be respectful for your time, I would want to wrap up by talking about trends that we're seeing. So a lot has changed. Prospective sellers that held off in 2021 looking for a better offer were probably pretty disappointed when they came around in 2022, 2023, right? Because interest rates.
Yeah. Yeah. It's still taking some owners a while to come back to reality on, the gap has closed in buyer and seller price expectations, but there's definitely some holdouts out there. Look, you missed the window. It was a great run there in 2021 and the market's changed. Debt's more expensive. So I think emerging brands are still a great opportunity because debt's less of a factor anyway. Debt's still on their mind, of course, for the private equity buyer. Mm-hmm. Another trend is all the businesses that traded between, like prior to the pandemic, so 2014 to 2019, all of those are going to be coming back to market pretty soon. So the funnel is going to fill up again with really good opportunities for new eyes to be on those businesses. But it also means all of the people in the deal mix are going to be very busy. The attorneys, the audit firms, the CPAs, the investment bankers, the brokers, everyone's going to have quite a lot of things to do. It's a good problem to have, but it means, if you're not really ready to go, you're not going to maybe get all the attention you were hoping for. Mm-hmm. So you've got to do some pre-work and some thinking before you kick off that process so that you understand that, because it's going to be crowded. Another trend I'd like to bring up is I think we're going to start seeing a lot more independent sponsors. And that's because, a lot of these larger brands with scale have already been picked up. Mm-hmm. So there are a few holdouts like Jersey Mike's and Subway that haven't ever gone to PE before. But, by and large, if you're a brand with scale and you want a private equity partner, if you raise your hand, you can find one, right? That's not the problem. But there's a lot of smaller brands that need help. They need operating assistance. They need capital. And I think that's where private independent sponsors are going to come in a bigger way to help those brands, because some of those brands have tried to go to market through a traditional PE channel. They might have hired a banker. They didn't get very good market feedback. And really the only ones who can take those on are independent sponsors. But this, again, also I think opens up some good opportunities for really solid, proven operators. You can find capital to back you.
Mm-hmm.
You could potentially go acquire a brand or a large multi-unit, franchisee block if you can show that you can get results.
Yeah. So you do reference family offices earlier in the book, that your prediction is that you think family offices are going to become a bigger player in all this.
I do. They're more patient capital. The disconnect is they're not operators, right? So they still need that operating partner, but they're more willing to be flexible. They might be willing to take a minority. So there are a lot of opportunities, I think, for family offices to play a bigger role in franchising.
One more thing I want to go back to in terms of the timing. Another advantage, I think, for a founder to get involved in having a private equity partner is that PE partner is going to see things that you don't see as it relates to going up the next rung. If I had still owned my company in 2021, I might have thought, I'm just going to keep holding and I'm going to keep going. But it was my PE partner that said, now is the time to go. It's go time. I didn't see that. And I totally respected them. I listened to them. I knew that they knew what I didn't know. And they said, things are frothy. This company is solid. You guys have grown tremendously out of COVID. It's time to go. And I said, all right, let's go. And now I look back, especially what you shared in the book about how multiples have come down. And I said, I thought to myself, wow, I did not see that coming. And that is another great reason to have a partner, because they will see the things, they will see around corners economically that you don't see as it relates to the private equity market, what the marketplace is paying.
Yeah, they see the market cycles, right? And they can see when things are getting frothy, as you mentioned, and they'll pull the trigger and move quickly when they're motivated. Remember that there's kind of a deal pile up happening right now. Mm-hmm. There's a lot of I think the average hold time is 6 years right now, which means they're already kind of long in the teeth and they need to find new landing zones for these things. So we are going to start to see more deals trade, and they're looking for good exits, not optimal exits in this kind of a market. If they've got to return capital to investors, now is potentially the time to do it. But you're right. They can see things potentially you don't see, or you're too close to see it. They're also networking all the time. They know who their landing zones are. They've already got a business case in mind with a terminal value on a spreadsheet somewhere of what your business, they hope that business is worth. And when they see that they're getting kind of close to what they had intended, they're going to start having those conversations with people and see if they can, get some interest.
Yeah. Alicia, I have enjoyed our conversation so much. If someone was interested in learning more, what are the ways they can stay connected to you?
Sure. They can go on my website, emergentgrowthadvisors.com. Or if it's easier to remember, bigmoneyandfranchising.com. Both lead to the same place, and they can connect with me there.
Alicia, thank you so much. Again, Big Money in Franchising. Highly, highly recommend this book, no matter where you are in franchising. It was a pleasure to meet you. Thank you so much. And I hope to meet you one day in person.
You're welcome. Thank you.
Thank you for tuning into the Emerging Franchise Brands podcast. For additional insights, guest applications, and to stay connected, visit us at efbpodcast.com. The Emerging Franchise Brands podcast is for entertainment purposes only, and the views expressed do not necessarily represent those of Emerging Franchise Brands, its host Frank Fiume, or Emerging Franchise Group, LLC. Any discussed franchise or investment opportunity requires thorough investigation, obtaining proper disclosure documents, and expert consultation before making any investment decisions. The podcast and its host do not offer professional advice or endorsements, and they hold no responsibility for actions, representations, accuracy, or consequential damages related to the podcast content.